In this video, we'll explore low-risk, high-reward options strategies that allow you to navigate options trading while minimizing risk and positioning yourself for significant returns. One of the most popular and beginner-friendly strategies is the covered call. This strategy involves owning the underlying stock and selling a call option on that stock, thus generating income from the premiums you receive. For example, if you own 100 shares of Apple, AAPL, at $175, you could sell a covered call option with a strike price of $185. By selling this option, you collect a premium, say $3 per share, or $300 for the 100 shares. If Apple's stock price stays below $185, you keep both the premium and your shares. However, if Apple's price rises above $185, you'll be required to sell your shares at that price, but still make a profit of $185 per share plus the premium you received. This strategy is ideal for stockholders looking for extra income, especially if they believe the stock won't rise much beyond the strike price. Another solid low-risk, high-reward strategy is the cash-secured put, which allows you to potentially buy stocks at a lower price while earning premium income. For example, say you're interested in buying Tesla, TSLA, currently trading at $250 per share, but you think it's overvalued at this price. You could sell a put option with a strike price of $230, which would give you a premium up front. Let's say $7 per share or $700. If Tesla's stock falls to $230 or below, you'll be required to buy it at $230, but your net cost is reduced by the $7 per share premium, making your effective purchase price $223 per share. If Tesla's stock stays above $230, you keep the premium without having to buy the stock. This strategy is great for those looking to buy high-quality stocks at a discount while generating income in the process. A third low-risk, high-reward strategy is the iron condor, which works well in low-volatility markets and limits risk to a defined amount while still earning premiums. With an iron condor, you sell an out-of-the-money call and an out-of-the-money put, while buying even further out-of-the-money call and put options to protect your position. For example, if S&P 500 futures are trading at 4,000, you might sell a 3,950 put and a 4,050 call, and buy a 3,900 put and a 4,100 call. This creates a range of 3,950 to 4,050 where you keep the premium if the market stays between these levels. The risk is limited to the difference between the strike prices, minus the premium collected. For instance, if the strikes are $3,950 and $4,050, the maximum risk is $100 per contract, minus the premium you received. This strategy is ideal when you expect the market to remain range-bound and low volatility, which can help you collect premiums with defined risk. Now, let's dive into some real-life case studies. In 2020, during the pandemic-induced market volatility, many investors turned to covered calls and cash-secured puts to generate income and acquire stocks at favorable prices. Warren Buffett's Berkshire Hathaway, for example, used the cash-secured put strategy to purchase shares of companies like Kraft Heinz, KHC, and Coca-Cola, Co., at discounts. By selling puts, Berkshire Hathaway was able to collect premium income and, if the stocks fell to their strike prices, acquire the shares at a lower price than their current market value. This approach allowed Buffett to use market volatility to his advantage, locking in discounts and securing premium income along the way. But it's important to note that while these strategies are generally lower risk than outright buying options, they're not without risk. For example, with a covered call, if the stock price skyrockets well beyond your strike price, you're still limited to the gain from the stock and the premium, which means you may miss out on bigger profits. In the case of a cash-secured put, if the stock price falls significantly below the strike price, you could end up owning a stock at a much higher price than its current market value, even though you received premium income. Iron condors, while limited in risk, can also be challenging to execute in highly volatile markets, where the price can easily break through the range you've set, causing a loss. The key to success in these low-risk, high-reward strategies is proper risk management. Always ensure that you fully understand the positions you're taking, the risks involved, and use proper position sizing. Additionally, you should monitor the broader market conditions to understand the volatility and trends. Understanding the market environment will help you better decide when to implement strategies like covered calls or iron condors, and when to exercise caution. These strategies can be powerful tools for consistent profits and building long-term wealth, especially when combined with a diversified portfolio. Whether you're a beginner just starting in options trading or someone with more experience, these low-risk, high-reward strategies can help you achieve financial success with defined risk and set you up for long-term growth. Always keep in mind that options trading is complex and requires discipline, but with the right approach, you can unlock opportunities for significant returns with limited risk. Subscribe for more update.